You are looking at a stock that just plummeted, but right at the base of the drop, two sharp downward spikes form. Immediately after, the price climbs, doubling its value over the next year and a half. This is the horn bottom. Today, we are building a complete system to trade this pattern. We will cover how to spot the true shape, filter out false signals, find the highest performing setups, and execute the trade with strict risk controls. Before we start, you need to configure your workspace. Open your charting software, change your time frame to weekly, and turn on your volume indicator. This setup is strictly required. If you try looking for this pattern on a daily chart, the signal will be completely buried in the day-to-day price noise. You must use the weekly view to see the structure. Step 1 is identifying the physical geometry of the setup. You are looking for a downward price trend that ends with two exceptionally long downward price spikes. Focus on the lowest point of this chart. These two deep spikes are separated by exactly 1 week. Look at that center week. Its low stays significantly higher than the spikes on either side, creating a distinct inverted horn shape. The pattern also requires clear visibility. Look directly to the left of the formation. There should not be any recent price clusters or downward trends obscuring the view. The horn needs to stand entirely alone at the bottom. Spotting this inverted horn gets you to the starting line, but the shape alone does not make it a safe trade. To confirm the setup, we have to evaluate the surrounding chart context. Step 2 is filtering out the traps. We do this by shifting our focus away from the horn itself and scanning the historical price action to the left. This chart shows a major trap. Look at the older downward spikes preceding the horn. They are equally long, meaning the horn isn't unique. Notice the declining peaks tracing a descending triangle. This base-forming structure indicates lower prices are likely coming. You also need to check for overhead resistance, areas where the price previously struggled to break higher, positioned just above your pattern. Historically, nearby resistance causes a throwback, forcing the price to retreat and hurting your overall performance. Trading the horn shape without checking these historical left-side filters is exactly how novice traders get caught in false breakouts. Step 3 moves us to offense. We want to evaluate specific physical traits that boost the pattern's success rate, starting with the height of the formation. You measure height by taking the absolute highest high and the absolute lowest low within that specific 3-week horn cluster, and calculating the difference. The data reveals that formations measuring taller than the median significantly outperform shorter patterns in overall post-breakout profitability. The second performance booster is breakout volume. The breakout week must occur on heavy volume. You want to see the breakout volume bar surge decisively above the stock's 1-month volume average line. By demanding tall patterns paired with high breakout volume, you ensure you're risking capital on signals that have institutional backing. Step 4 covers the exact mechanics of the trade. You have a valid, high-performing pattern. Now you need to know precisely when to enter and when to exit. Your entry requires strict confirmation. Draw a horizontal line at the highest high of the 3-week pattern. Wait for the price to close above it. Then immediately set a protective stop loss up to $1 below the lowest point of the two horn spikes. Placing the stop this far down gives the trade necessary breathing room. Prices frequently curl around and retest those lows before recovering. A tight stop will knock you out prematurely. For your exit strategy, do not buy and hold. The moment the upward trend breaks, sell your position. Statistically, after reaching their ultimate high, prices tumble heavily, dropping over 30% on average. Holding too long guarantees you give back your gains. Patiently waiting for the close, giving the trade room to breathe, and selling the moment the trend breaks. This disciplined execution converts chart theory into actual profit. To recap the framework, spot the twin, 1-week separated spikes, filter out left-side traps, demand a tall pattern with heavy breakout volume, enter on the close, and exit when the trend bends. Before you risk capital, pull up historical weekly stock charts and practice. Train your eyes to spot the correct geometry and identify the traps. Please note that this video is for educational purposes only and does not constitute financial advice. All trading involves risk, and past performance does not guarantee future results.